Welcome to Mutual Fund Family.
Log on to mutualfundfamily.com for more info.
The next funda for investing is invest regularly. It is quite true that investing regularly inculcates a disciplined habit in us, and it also helps to combat market volatility. Therefore, one must invest regularly without worrying too much about timing the market. This can be done through Systematic Investment Plan, SIP, which works on the principle of rupee cost averaging. It is a strategy whereby an investor commits to invest a fixed amount of money at specified intervals. This ensures that he buys more units when the prices are lower and fewer units when prices are higher. However, over a period of time, these market fluctuations are averaged, and average cost of investment is often reduced. Let us again take an example to explain this concept. Say Mr. X, Mr. Y and Mr. Z purchased units of a particular fund at different intervals in different market conditions. Mr. X invested in rising market conditions. Mr. Y invested in falling market conditions, while Mr. Z invested in volatile market conditions. Each one of them invested rupees 1,000 every month. In the first month, per unit cost was rupees 10, so each one of them is allotted 100 units. In the second month, for Mr. X, the cost per unit in rising market conditions increases to rupees 12, which further increases to rupees 14 and rupees 16 in the following months. At the end of 4 months, if we calculate the average cost of each unit for Mr. X, it comes to rupees 12.61. Now Mr. Y, as we have assumed, has been investing in a market that is showing a downslide. The cost of units in the following 3 months decreases to rupees 8, rupees 6 and rupees 4 respectively. But on an average, the cost price of each unit comes to rupees 6.23, and he is able to accumulate more units into the fund. For Mr. Z, who has invested in volatile market conditions, the average cost comes to rupees 9.8. But let us say that if we invested a lump sum amount of rupees 4,000 and purchased 400 units, the average cost per unit would be rupees 10. Thus, we can conclude that while rupee cost averaging does not guarantee us a profit, it ensures that our average cost of acquisition is lower in most market conditions. Moreover, this strategy insulates us from the risk of getting the market entry point wrong. The next funda is diversify your portfolio. What we mean by diversify your portfolio is to mitigate your risk to an extent. The risks cannot be completely done away with, but we can look to minimize it greatly by diversifying across different asset classes. However, care should be taken to include assets with low correlation in the overall portfolio. This ensures that underperformance by any one asset class is balanced by good performance of other assets in the portfolio. For example, a downturn in the equity market can be probably offset by good performance by other asset classes such as gold, real estate, etc. The seventh funda of investing is decide your asset allocation. As an investor, to achieve your financial goals in time, following a proper asset allocation strategy is a must. Asset allocation is done with a view to create a strategic mix of different asset classes in the portfolio, to optimize returns potential and at the same time keep the overall risk at low levels. Your financial objectives and risk appetite plays a role in deciding the suitable asset allocation mix. For example, if you have a good risk-taking capability, a higher allocation to equities is advised. The eighth funda of investing is rebalance the portfolio regularly. As market dynamics change over time, investors should review their investments periodically and rebalance it if necessary. There are no set principles on how often investors should rebalance their portfolio. But conventionally, we can do it every 6 months. Rebalancing helps you maintain your target asset allocation. The original ratio might have changed because of appreciation in value of one or more of the asset classes, or decline in the value of another asset class. For example, a portfolio originally having a composition of 60% equities and rest in debt instruments may lose its original composition due to the appreciation in equity asset class. Therefore, it is advisable to book certain amount of profits in the equities and invest the proceeds in another asset class, so as to restore the original balance. This instills some investment discipline in us as well, as we book regular profits in performing asset classes and buy units at a low price in other distressed asset classes. Thus, we have seen how important a role these fundas play in our investment planning. Let us reiterate these fundas. Funda 1. Any time is a good time to start investing. Funda 2. It's time in the market, not timing the market. Funda 3. Invest with a long-term horizon. Funda 4. Start early. Let time and power of compounding work for you. Funda 5. Invest regularly. Funda 6. Diversify your portfolio. Funda 7. Decide your asset allocation. Funda 8. Rebalance your portfolio regularly. We are sure this module would have equipped you with enough knowledge about planning your investment needs. We wish you a safe and happy investing experience.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Thanks for watching. Drop a like, leave a comment, and don't forget to subscribe Mutual Fund family.